What's up guys, this is Shana and welcome back to the iherng podcast, and today we will answer a question from email. This is a rather long one. Let's go. So, hi iherng, YK here. I've been watching your videos since the end of the last year and you've been a great inspiration to me in building long-term wealth through property. I really appreciate how genuine and honest you are every time you share your knowledge and opinions with the audience. I've also joined FarCap last month and I have no regrets. Congratulations. For context, I'm 29 years old and currently working in the helping profession in Malaysia. I'm a first-time home buyer and currently looking for my first investment property. My monthly income is about 5,500. I've set aside 6 months emergency fund, reserved 50,000 in saving, and have secured a comprehensive insurance plan. Although I'm still young, I've always aspired to retire early and achieve financial and time freedom. My ideal investment goal is to aim for positive cash flow if possible. However, I've noticed that projects aligned with this goal are often new developments that require some capital, offer minimal cashback, and take a few years to complete. Although you discuss capital appreciation in several videos, I hope to seek your perspective based on my current circumstances. These are the questions I would truly appreciate your insight on. Number one, by the way, there's like 6 of them lah, so Number 1, after learning more about property investment, it seems that buying a completed or near completed project is more advisable if I plan to purchase several more properties over the next few years. However, some of the available completed projects offer high cashback, which is attractive as a first-time home buyer, but the monthly cash flow is negative. I will have to wait patiently for capital appreciation. What's your view on buying a property with high cashback but negative cash flow? Question 2, based on your experience with capital appreciation focused investment, 4 points. Point number 1, what are the key factors to access potential capital appreciation? Number 2, when is the best time to exit? Number 3, I've noticed the market is currently saturated with studio units. Do studios typically perform well in terms of capital appreciation? Number 4, I'm currently considering a unit in Hatamas area, specifically Dora. So for those who don't understand, Dora is a secret code name for projects in Far Capital because you are not supposed to actually tell which project you are buying if you are a Far Capital client. Just for information. Do you think this area has strong growth potential? Number 3, if I proceed with this property, I'm also planning to purchase another unit, either the one you bought in Dutamas or a new project in Maluri you discussed in Deal or Grill. Again, Deal or Grill is a show, it's a bi-weekly show where Far Capital will actually host a webinar online where they discuss all properties available to kind of establish clarity on projects based on data and based on the information that is given by real estate agents. A lot of them, they will tell you like 5 minutes to meet value, which didn't happen. They will tell you 12% return, which didn't happen. Very exciting show. Anyway, back to the question. Getting a new project I've discussed in Deal or Grill, use the cash back next year. Do you think it's too aggressive for me or am I overcommitting? I'm not sure where to draw a line in expanding my risk appetite. What would your advice to someone be who aims to own 10 properties within the next 10 to 15 years? Number 4, I'm also considering joining other investors group which focus more on sub-sale and auction properties. I'm aware you don't recommend auction units for first-time buyers, but I wonder if joining a group specializing in this area would still be beneficial for a better deal? Number 5, based on my situation, would it be wiser to stick to my investment goal of positive cash flow, even if the project will only be completed in a few years? The downside is that I will need to fork out extra money before I can enjoy the cash flow, and I'll be torn between options. In your video, number 6, you've mentioned that housing loans can help reduce taxable income, but would it be better to settle the loan early so rental income becomes pure profit? If I have 50,000 in hand, should I place this amount into a flexi loan amount to reduce my loan tenure and interest? Alternatively, if my outstanding loan balance is down to 50,000, would it be wiser to take that money out and slowly repay the loan using rental income until it's fully settled? Thank you for taking the time to read my long email for addressing my questions. I sincerely hope to meet you at one of your future events. I've been looking forward to learning more from you. Warmest regards, YK. Okay, so let's just jump into it, right? Because it's a very long one. So, 29 years old, first-time home buyer, income about 5,500. And I absolutely adore this, right? Because you kind of watch a show already. So before every first-time home buyers wants to embark into this property investment, my criteria to that is at least to have an income of about 5,000. then you will have 6 months emergency fund, which you have here. So you kind of have 50,000 in savings and a comprehensive insurance plan. The only thing that is a little bit more vague here is the clarity in career. So the investment goal is positive cash flow. And question 1, buying a completed or a near completion project is more advisable if I plan to purchase several more properties over the next few years. However, some of the available completed projects offer high cash back. So what's my view on buying a property with high cash back but negative cash flow? Let's address the first half of the question first. We are encouraged buyers to actually buy projects that is completed or near completion if you want to build a portfolio. And the keyword here is you want to build a portfolio faster. So 2 scenarios, right? One, if you buy new straight away from the sales gallery, you need to wait for 4 years, and for higher density projects now, the construction period can be about 60 months, which is 5 years time. A lot of things can happen in 5 years time, and the worst thing for a property investor that is very ambitious, very high in risk tolerance, is I need to wait for 5 years doing nothing, and the property slot is taking up my DSR, leading me to not be able to capitalize on better deals moving forward. So the strategy that we adopt in our community is we buy ready-built properties. So it takes about 5 to 6 months time to get the ownership transferred over. We spend about 1 to 2 months time getting the unit fully furnished, and then we rent out the unit for another 6 months time. We can declare the rent collected as income to the bank to support our application for the next property already. So this sounds a little bit so rushed, right? For normal people, it's why so rushed? Confirm make money, man, this property. That seems to be the information gap I realized after speaking to so many people. A lot of people will be very worried on whether the property can break even or not. When they do the research after they invest in the property, not before. So for those who have made informed decisions, we kind of know what to do already even before the keys are handed over. That's why it's pretty much automated on the entire process. And back to the question, that would be the main difference. One, you need to wait for 5 years. One, you can almost instantly buy. And the thing about this particular moment in time is data indicates that the property bull run is coming. It means that the rate of transaction is getting higher. In fact, the last quarter of last year, we had the best transaction quarter of the decade. It's that hot, right? And to match that with the current shortage in supply. Yes, this sounds pretty crazy, but if you look into the number of supply before COVID days versus the numbers now, we are nowhere close. Right? That results in a very healthy buying for a lot of brand new projects. And if you look into the similarities, the brand new projects now are also pretty conservative in their pricing. Not like crazy before COVID times already, because everybody has learned their lesson from COVID. A lot of contractors, a lot of developers lost money just to complete the project as their cash flow was affected, their profit margin was affected by the lockdown heavily. So because of that, now the prices of property that we see are a little bit more genuine already. So that's always a good thing for investors. And because of that, now we are trying to build our portfolio as much as possible, getting ready for the bull run to take off. Technically, we are already in the start already, just that a lot of people don't feel it yet. This is in contrast to the normal behavior for a lot of buyers, because a lot of buyers will only want to buy property when it's hot. That's why a lot of people lose money. When's the best time, right? I always ask myself this. When's the best time to make money? Is it when the market is good or when the market is bad? On theory, everybody will know. Just buy at the bad time, buy it at its worst time, right? When everybody throw stock out, then you buy. But in reality, we behave absolutely different. Just look back into the day when the US president announced the tariff, right? The whole market crashed. Everybody was just lining up, rushing to exit the market. That was the best time to buy. During lockdown, right? Property market was trash, right? Transaction was almost zero for a few months. That was the best time to buy. And once you get the hang of it, right? The best way to react to the market is to adopt this contrarian thinking pattern, where when everybody wants to exit because it's losing money, right, or whatsoever, right, then you need to trust your own research work. You gotta be really clear on what's the market sentiment, what's the data point that you're referring to in giving you confidence to pull that trigger. So I got a lot of units during the lockdown period, and all those are paying off already. And now what the community is actually thinking about is to build this portfolio waiting for the bull run to come instead of buying during the bull run. And that explains why a lot of people actually lose money, because they only buy when times are good. But pricing reflects that as well. So it's somewhat also that musical chair theory where it depends until when the last person will get the chair and when the music will stop. You will never be able to time when the music will stop. So the key is to invest before the music even starts. So regardless of when you want to exit or not, or you want to hold for the next 30 years in accordance to my theory or not, entirely up to you. But to ensure that we make money, we need to really adopt that contrarian thinking pattern. And just for information and clarity, right? Far Capital is a property investment company that does bulk deals. They are also doing a lot of loan application. They are doing this prop tech thingy, which is very successful right now. And it's not my company, right? Just for clarification, I'm just a client, right? I buy deals from them. In fact, I bought my last 4 properties from Far Capital at the same price that you guys are buying, if you guys are a member lah. There's no special treatments for me even though I'm a YouTuber or whatsoever. No such thing. And within the deals that they are getting, because they always buy in bulk, the price of properties that they get is extremely attractive. To a certain level, sometimes it's quite crazy lah. But when they advise clients on which property to pick, they'll emphasize on what is your objective of buying the inventory. Like, do you want high cashback? Do you want cash flow? Do you want high capital appreciation? Or you just want to maximize your portfolio? So it's a very different conversations from the normal property buyers, because here the deals is almost guaranteed make money already because of the very low entry price against the market price. So the question here by YK then is like, do I buy a high cashback property but every month I still lose money? Again, it depends on what's your intent. A lot of people will never be able to get out of their previous bad habits of swiping the credit cards or taking personal loan or things like that. So buying a property might be the only way out of it. Due to the lack of financial education, right? A lot of people just swipe and create all and build up these loads of bad debts. And we think about credit card, it's about 18% a year. We think about personal loan, it's about 8% a year. And just berlambat-lambat on the hutang lah, right? So the only way to roll about it is to have this massive amount of capital to kind of settle it or drag it for long in restructuring or whatsoever lah. However, now they are just stuck in that cycle where their income is just enough to cover the interest. They can never resolve the principal amount of the debt. So it's a very scary loop. It's a vicious cycle. So what this company helps them to do is when you get a property deal with a huge cashback, maybe like 50,000 or 100,000. This depends on whether the applicant can qualify for that amount or not. So they use this 100,000 in settling all these bad debts. Right? Now your credit card is clear, your personal loan is cleared, you only have a housing loan, but now the tenant is helping you pay most of it. Now left with maybe every month you 200 to 300 negative lah. This might be very foreign to a lot of people that has no debts. Like all this while you are very disciplined and frugal with your spending, right? Why I want the cashback, right? Might as well I just take a lower loan so the property can generate positive cash flow. Yes, that would be the right way because the agenda of buying this property will be different. For yours, you would want healthy cash flow. So every month, I will have a rent that is higher than my monthly installment. I can use that to build further in my portfolio, right? That's the right way to think about it. But circumstances are different for everybody. So sometimes when we have a huge load of debt to settle, this might be one of the effective ways. So the answer to YK, it depends on what's your intent. In fact, a lot of business people actually buy property for the cashback, right? Although it's not as open, but it's somewhat like this open taboo. Everybody knows it's happening, but nobody dares to say anything about it. Besides this fella. How they think after I interview them, right, is housing loan has the best form of interest in the market. It's the most competitive rate. The other loans that is more competitive is PTPTN, which you can never get lah, right? So what they do is they buy a property that is self-sustaining, then they use this extra cash flow as an overdraft facility. Because if you take a business loan, it's going to be about 6 to 8% depending on how strong your profile is. It's very hefty, but if you get a housing loan that is about 3.8% today, and you can actually settle it and offset the interest anytime you want if you have a full flexi loan. So that is the attractiveness of how people use housing loan. When their business is good, they'll have extra cash and capital, they'll put it into the housing loan account. knock off the interest first. Then sometimes when times are bad, oh, I just need some cash flow to roll the salary, I will just withdraw out again, settle it. I think my collections are up to date already on my clients, then I will put back the cash again and roll again. So it's a very fluid game, unlike employment setting where we buy, hold there, every month rental come in, every month rental come in. It's a very stable, very slow paced interaction with money. And lately there has been a very interesting conversations around the Malay community. In fact, we kind of touched this on the previous episode, but it's about men approaching 30. Right? At the age of 30, this would be this hefty phase of money burning lah. We need to get married, right? We finally want to propose to the other half. To propose also with the intent of building a family. So what you need? You need a house. Before that, you need a wedding. Before that, you need a car. And you need to have kids already, right? So it's this series of non-stop, very exciting events. But money is also part of the equation lah. So where to get this capital? By the time you expect me to have a six-figure amount in my savings, right? I don't think 30 is the right age lah, or 28. It should be like 35 or 38 if you're within the top B40, M40 route kind of range. If you're part of that T20 category, I don't think this is even a conversation. But for a lot of people, that will be that need for them to actually pull the trigger for projects with high cashback, but yet negative a little bit in their money cash flow. So in their mind, they do not expect the property to really make money already because the intention of the property was the initial cashback. So that's the intent lah. To me, if you can afford to not have the cashback but you have positive cash flow, I would choose that. Because those are not free money, you will need to pay interest on it eventually, right? But if I were to just not take it, even if the banks do offer the cashback, I'll just take. Eventually, when I have that in my savings account, I'll put it back to the housing loan to knock off the interest. Because a lot of people don't know what to do with the money. If you know a way that can generate higher yield than the 3.8 to 4% of the housing loan interest, then I think you should do something about it lah. If you don't have the skill sets to it, what's worse is if you lose money on it, which is the exact wrong way. And that leads to all these auction properties from the previous guru teaching lah. So the philosophy is pretty much the same. After speaking to a lot of students of theirs, right, with the massive cashback, it's very, very attractive for people who have not had that amount before. Suddenly, when you buy a property and you have 6 figures in your savings account, right, wow, it's very... And the game plan is to get the unit rented out, negative cash flow, right? So every month you need to pay back about 500. You will have this amount, let's say 100,000. The goal is to slowly take this 100,000 as a buffer to slowly put back into the account. Maybe you put half into FD first, so half is to use as a fluid or current account to actually just pay back the property, hoping that the property will resume in pricing and you own the property eventually. The terrible things that happen is then the lack of discipline of the buyer's side. What they do is they use this cashback to run their business that is losing money. Or they would bring their whole family for a holiday, leaving half for the buffer to the property, or they actually just ball. Suddenly when you have 6 figures, right, the latest Honda Civic looks kind of cool, but the common thing to do is to blame the person providing the deal instead of themselves mismanaging the fund. To me, just let's be very objective about it, right? The deal is fine. The deal was supposed to take this as a buffer to slowly pay back. But it's the lack of discipline and money management skill that caused this whole thing to happen. So you don't know how to gear yourself, or you don't know what gearing even means. Unfortunately, those are the ones that pay the price lah. Okay, so back to YK. If possible, I will take the one without the cashback. Then I will have a positive cash flow property where every month I will make money off the property, and I'll go for my second one already. Moving on to the second question, there's a few breakdown lah. What are the key factors to access potential capital appreciation? To me, it's very closely related to rental rates. So it's no longer like last time. Okay, so let's divide this into two categories. One will be the landed communities. The others will be the high-rise projects that we are more inclined to. Okay, the capital appreciation within landed houses is based on placemaking. How you make money, it really depends on how much more another person is willing to pay so they can enjoy the address. For example, Desa Park City. So it was launched 15 years ago at 400,000. Now it's actually 2.4. Imagine the person who bought at 1 million. The whole world will be laughing at him, right? You see 1 million want to buy until the next person who buy at 1.5 lah, right? Wow, 1.5, siao, this fella don't know how to invest or not. Then the next person buy at 2. So there's no justification on when the next person is going to pay more for it. So back to that musical chair theory, right? It depends on how far you think you want to go. The same thing with Setia Alam, the same thing with all major landed properties lah, because it's the want that drives people crazy. Every Malaysian almost lah, besides people who stays in Penang, but almost all Malaysians wants to have a landed terrace house, right? But because of that one, the landed terrace houses around KL city centre is just priced very, very highly. So that's one side of the story. The other side of the story is for high rises, then I believe, or we believe in the community, is rental rates will justify the capital appreciation. So let's just take a live example. My property in Mont Kiara, everybody know where I bought already, right? So I bought about 1,900,000 each. Okay, so my monthly installment is about 3,000 each, 3,008. But my rental now is actually 5,003. So every month I'm actually generating 1,500 in positive cash flow. We don't calculate maintenance first, but let's just stick to this, right? What does this positive cash flow mean? For every 500 extra, if you were to take a loan from the bank, it means a loan of an extra 100,000 in value. So in other words, if I take a 100,000 loan, every month I will need to pay the bank about 450 ringgit per month for the next 35 years, and the interest rate for this calculation is about 4%. So if you reverse calculate that, 1,500 surplus equals to 300,000 in loan amount. And why is this important? Back to my example, let's say mine is about 950,000, okay? You put in this 300,000 value to it is about 1.25 million. Imagine the next person who wants a property where the rent can cover installment easily, even if they buy it at 1.2 million, the deal is still sensible for them. That's how positive cash flow in rental direct translates into value of capital appreciation. Why a lot of people lose money in property is because the rent cannot cover installments. So let's say your installment is 4,000 when you buy about 1 million, right? But now the rental there is only half the price at 2,000 ringgit. So for the next buyer to actually acquire your property, is either they really love the location and the setting and your ID and everything of the property to the max, because to buy for investment, right, it just doesn't make sense. Will you actually buy a property where every month you pay 4,000 and the rental collection is only 2,000? Every investors know how to do that calculation. So the most direct way to get a property for capital appreciation is really to buy a property where rental is way higher than installment. And this happens only to tier 1 locations. In accordance to Far Capital's research methodology, they kind of dissected locations into tier 1, tier 2, tier 3, tier 4s, and they will have specific criteria to them. And most of these projects, right, are mostly located in tier 1 locations. Why? Because there's no limit or no cap to the rent. And this is crazy. Like for Mont Kiara, 5,003 for a 1-bedroom unit seems reasonable. Just like their nasi lemak that's selling for 38 ringgit is reasonable. But if you just step away, you go to TTDI or you go to Taman Sara Utama, right? Siao, who will actually rent a space for 5,003? 5,003, I can get a landed house already, like, please. And that's the difference in mindset just by having one street away. That also justifies their research work in different mentality in different locations. Why do they think that way? Because, I don't know, they got money lah. But to me, I'm just capitalizing on it, leveraging on it. And for you, YK, who wants to target high capital appreciation potential locations, usually it's within all these tier 1 locations lah. Next will be, when is the best time to exit? Entirely up to you. But technically, there's 2 theories to it. One is when that location has no more story. Because the weirdest thing is Malaysians buy property, it could feel, it could emosi, right? Not like Singaporeans, they buy properties really follows data one, which is something that I'm strongly encouraging everybody to do, but it's rather challenging, to be very honest. Generally, the news, the narration of something exciting within a location drives the property market way more compared to the completion of the thing. Look at the MRTs, right? Last time, wow, the MRT is going to be built here. And people use that as the news and narration to sell a particular project nearby. But once it's completed, right, Nothing much, right? So what's exciting now, if your project is located close to Bandar Malaysia, where HHR is going to be the next big thing, don't know when will happen or not, right? But you see the news, everybody is capitalizing on it, selling on it already. Just like how RTS is in Johor, just like the Bukit Jalil Pavilion example as well. Before the mall was completed, right, it has bigger buzz compared when the mall is completed. Everybody like, meh, like that anyway. So until the location is fully matured, no more news or no more potential things really, you want to let go lor. But that's also provided you know what to do with the money after letting go. And here also ties very closely related to human behavior. If the property is generating 1,500 to 2,000 positive cash flow every single month, right, would you want to let go? Like, why would you want to let go? Because the next question then is, if you sell off really, what to do with the money? If I sell and I have a $500,000 profit, do I want that $500,000 or do I want extra 2,000 or 2,500 a month in cash flow? Which one you want? And that's the weirdest thing. A lot of people don't want to sell when the project is making money. People only want to sell when the project is losing money. That is why money-making projects will keep going up in price, because everybody just hold. That's why it's very, very important to really rely on the research work. Before that, you really need to do your research work lah. Then another school of thought of when to sell is never. Like for me, if I were to hold for the next 30 or 35 years, the project will 100% be mine. The only criteria for my investment is the rental higher than installment. All projects can be self-sustaining and I need to do nothing for the next 30 years. So when I start at 22, by 52, I already start owning properties one by one in completion without any debts. Do I put more money into the housing loans? Not really, because I study a lot in trying to make money work harder for me, so I know what to do with capital. Now just let the properties just roll out itself lah. And that will be very, very exciting. So when I'm 52, right, I will start collecting one after another for the next 10-20 years, right? Project completion in loan one by one. Wow! Come to think of it, exciting. Do studios typically perform well in terms of capital appreciation? I think this is a wrong question. This needs to be tied with the correlation of location. If you were to build a studio unit, for example, in a location that is more residential oriented, for example, if you build a studio unit, right, in city of Elmina, it will die. Literally. Why? Why would anybody want a studio unit? First, it's smaller in build up, right? Resulting in a smaller ultimate selling price. Only people can afford. And these are applied in locations where land price is just very, very high. So if you look into locations with high land price, right, it's like the city, CBD, so like Mont Kiara again, Bangsa South, KL Central, KLCC, Bukit Bintang area. That's why studio units there seems to be doing very, very well. But let's not get confused with the fact that ultimately it's an affordable thing. Like, you think people don't want a penthouse in KLCC, meh? Cannot afford, ma. And the main reason why people goes to outskirt location, move away from the city, like all the big landed houses, right? Why? It's a location that can provide a housing typology that they can afford. If a brand new house that is built by all these developers located within Jalan Ampang area next to KLCC, right, you think people wouldn't buy? At 800,000? I will fight like mad just to buy it, right? But how much do you think it will be priced? 2 million? I think 2 million also cannot break even though. 4 million? So what alternatives do people have then? Studio units in the city. So this is a very good question actually. We always need to tie the product type against the location. So throughout the channel, we have visited a lot of, I won't say failures, I would just say products that are mismatched with the general buyers of that location. So like for an outskirt project, like I think we saw one around Denai Alam area, but they are selling a mini unit. I think it's about 380 square feet only. It did really bad. So the rental is about 1,000 or 900 for the room only, and for 900, people still think that it's too expensive. And a lot of people then who didn't do enough research, right, will just be attracted to the fact that, wow, 200,000 for the unit, I think can they? But they don't look at where the location is. So they made the mistake of buying the cheapest property possible. The goal of property investment is not really to buy the cheapest. The goal of property investment is to make money via properties. So for the project that you are thinking of buying in Hartamas, right, that one I would just suggest to speak to your success manager in Far Capital, right? So it's their job to actually convince you or to recommend you what to buy. not me. Based on all the factors above and explanation above, right, I think you kind of know whether is it a good buy already or not. So if you were to buy that property, you want to buy another one that I bought in Tutamas or the one that I bought in Maluri as well. So do you think it's too aggressive and are you overcommitting? So where do you draw the line against your risk appetite? To me, take it slow, right? From a person who have got beaten before from my previous mistakes, right? There's no rush. I'm so excited to look at your goal, which is to own 10 properties within the next 10 to 15 years, right? It's very important to really differentiate the goal and why you are doing it. A lot of people make statements like this just to sound cool, right? It's so cool to own 10 properties in 10 years time. It means you need to buy one a year. Is it realistic? Because like now you have the first year, you're 90%, the next one is already 70%. Then you will need a lot of capital to do it. But let's face it, right? Tie back to reality, right? Your income is only 5,500 full-time plus part-time. Let's not forget that a lot of people who are building portfolios, their active income is solid one. We're talking about 30,000, 50,000, 100,000. A lot of people don't want to tell you that. So, my sincere suggestion, right? But then you will come back like, hey Sean, you always say what you want 25 properties, right? But I didn't say until when, ma. The timeline is the one that is really making it very tough on you. And sometimes because of that goal, right, you just chin chai buy for the sake of achieving that goal. So now I kind of refine my goal of 25 properties, right? If 25 properties, I can just buy a stack of low cost and I just call it a day. Not that difficult, ma. So a low cost is about 50,000, 60,000. I buy 10 of them, it's only like 600,000. No big deal, right? So I spend a lot of time in actually understanding myself, my circumstances, and refine that goal clearer to an extent where, okay, my goal now is 25 properties or 20 million worth. 20 million, it's the objective. So like 20 million, I can some property more than 1 million, some property less than 1 million. So give and take lah, right? So it's about 20 million. And 20 million, why 20 million is because after speaking to so many millionaires and almost billionaires, right? 20 million is a very solid amount to really live carefree in Malaysia lah. And the criteria for a project to be added into the portfolio must be self-sustaining, where the renter can cover installment, and it's something that I like. A lot of people will buy properties, hey, I don't like one, but the renter is doing very well, right? The funny thing is this, nobody is forcing you on that goal. So 10 properties in 10 years to 15 years time, right? Wow, even as a person who have done it really, right? It's tiring, like. So it suddenly becomes a chore. It suddenly becomes another career to do, right? My suggestion again, just take one at a time. Like after you buy this Dora property, right, that with a positive cash flow, think about it, then you push on to the next. So you don't want to put out so much capital, you can buy the new one, which is the one in Maluri. Okay, so go slow. No one is really forcing you. The whole goal of building this investment thingy, right, is to free up our own time so we can do things that we always wanted to do with the people we love anytime we want. That requires a lot of health, that requires a lot of free time, a lot of stability. My recommendation instead, when you start buying your first, get it ready, buy second, get it ready, get it rolling, buy third, or buy fourth. This is rather passive in your work schedule, right? Your active income, put more emphasis on it. That is going to dictate on how your portfolio is going to perform. Because let's say if your property suddenly got leaking issue, you need 20,000 to fix it. Is it going to burn you, or will you feel the itch, or just meh? That's the level of investor that you need to be, or you can strive to be. Go slow, okay? My suggestion is really like to go slow. Don't so kanjiong. Relax, and this is very surprising as it comes from me. Okay, so when you buy one or two, right, you are already ahead of a lot of other Malaysians already. Always remember this, I personally believe this. Property will not make you rich, right? Property keeps you rich. So when you have 5,500, you buy one, then when you start collecting rent, you will have this income already, which is like you collect 2,000, 2,500, right? Now you're a monthly 8,000%. So as you grow for your active income, now suddenly becomes 6,500, 7,500, 10,000. Meanwhile, within that journey, you buy another one and you call it a day for some time. Go enjoy life a little bit because you will have a lot of extra expenses here and there. What I don't want is for you to lose the ability to enjoy life because you will have this mega commitment to this goal that was set by nobody. It was a mere thought from the sky and that's about it. You know, there's no guarantee. And always remember there's no guarantee that this will confirm make money. Next question. YK is also considering to join other investor groups. They focus more on sub-sale and auction properties. To me, it's this lah. How much bullet you have? Okay, so it gets really confusing. And this is not me citing whichever property deals or whichever property company. You do whatever you like, right? The only thing is you gotta know ultimately, right? How much can you afford? Illustrate a better scenario is if you have 20 million lying in a bank. Very different scenario. Okay, you want to really know what's the best deal in the market, so which strategy works better for you. And my worry now for you asking that question is, let's not get confused with learnings, right? Learning is all good, right? The more knowledge, the better. Ultimately, what brings results? Execution. The trouble with a lot of students of this kind of groups, right? If you look into the number of success versus the number of people attending courses, right? What would be the difference? A lot of people misunderstood learning with doing. Unfortunately, it's not. Ultimately, it's us pulling that trigger, slowly following up with the deal, getting it done, getting it renovated, getting it rented out. Then you've collected your first 6 months and you go step by step again and again and again and again. You want to do it with auction, you want to do it with sub-sale. Absolutely possible. My suggestion is to just pick one and execute. So like Tim Ferriss always say, we can do many things in life, but one at a time. So focus more on execution. That would be my recommendation. Then the next question we kind of have answered already, where if you have 50,000 extra money, right, should you put it into the flexi loan to reduce the interest, or should you actually just not settle and do more about it? Ultimately, we covered it in the last episode where it really depends on you. Because some people may consider the interest savings on your tax income is marginal compared to the peace of mind that you will get. Ultimately, entirely up to you. But if you really understand how banks work, if you understand how the financial world works, everybody are just attracted to property investment mainly because of the 90% leverage. And 90% is only something that Malaysia can enjoy lah. We can enjoy up to 100%, 110%, which is crazy. The whole world market norm is 25% down payment. So at most you can get 70% or 75% financing of the property, and that's very attractive to a lot of people already. That's why Malaysians, we are very lucky. But ultimately, what's your perception of money, and do you have the knowledge to make it grow higher compared to the housing loan interest? If you cannot beat 3.8% on an annual basis, right, may I suggest to not invest in everything else, just put the money in the loan account. At least you can save definitely on 3.8%. If you can perform better, do your thing. And that's all for all the questions. What a lengthy series of questions. There's so many questions within this question, right? And I love it. I absolutely love it. So it only shows the enthusiasm, the passion of property investment. And this reminds me of my very first time of buying a property also. That time, don't have so many advice also. So all these questions I need to figure out myself. There's not much people to ask to unless I need to pay money. And just looking back, right, how fortunate the market is right now, based on the deals that you get, based on the information available, based on all the other alternative assets. But overall, right, just overall, my goal for YK here is congratulations in adopting that mindset in property investment to really focus on growing your money using credit, right? However, my concern for you is your thought process are within the clouds sometimes, right? Especially when you tell me you want 10 property in 10 years, right? Whoa, that one. So my suggestion is to go slow. Let's tie back to reality because your salary is still 5,500. That's a very big reminder. Focus on your first property deal, right? And if you want to get based on whatever that you suggested, you buy your first one there in Hartamas, the second one in Dutamas, the third one in Cheras. It's all good, but those needs to get rented out first before you proceed to the next. Meanwhile, focus on your active income because that will ultimately dictate your investment game moving forward. And that should be the game. Please do not expect property investment is a way for you to stop working so you can collect rent for life and don't need to work when you're 35. No, that's not the goal. Please do not expect the investment income to kind of replace your active income in the nearest future. No. It's supposed to happen when we are 55, 60, 65. Then suddenly you will lose that pressure in trying to perform against time in a competition that nobody is racing with you. I appreciate the enthusiasm in trying to excel, but let me just pull back a little bit, right? Focus on execution. And with that, thank you very much for your email. I really appreciate it. And for those who still have any questions regarding real estate, do just email me at taniherng @gmail.com, or you can just DM me on Instagram, iherng, and I'll see you guys on the next one. Ciao.
When love comes in